Another day and another quiet showing for Wall Street. We continue to stall after Monday's rally for a second consecutive day, feeding our speculation here that maybe that's all that there was of that news about the end of the shutdown, that the markets really had anything to work with. But there is something else that's going on here that's a bit incongruous, and that's what we're going to focus on here. This is Macro Money. I'm Ilya Spivak, head of global macro at tastylive, and our focus today is going to be on the surge in gold prices. Of course, we'll check in with the rest of the markets, see what's going on, but what we'll find as we do is that the thing that really stands out in a market that's otherwise relatively listless is the situation in gold. And it's fundamentally different, seemingly, even from how gold prices have tended to behave historically. And so it's an interesting exploration here, and we'll see if we can't make sense of it. But before we do, let's first take a look at what these markets did today. As we can see, performance still relatively listless in stocks. NASDAQ manages to claw its way back to even in the last moments of the trading day. That's thanks to those Cisco earnings that came out after hours and gave the futures a little bit of a lift. And of course, those results beat expectations, not by a mile or anything of the sort, but nevertheless, they were relatively upbeat. And so that's what we end up with here. Otherwise, the NASDAQ would have been down on the day. The S&P 500 was higher, was lower, ultimately settles little changed. We have a situation in the yields here, and those are yields on the 10-year and the 2-year there. They're down as the bonds are up. But again, no big changes there. Instead, we end up looking at a situation where there is, generally speaking, a sort of oscillation inside ranges, but ultimately not anything running away anywhere. Crude oil has the biggest move on the day. It's down almost 4.5%. That's thanks to inventory data that we got, suggesting that supply is yet more ample than expected. We look here and see that the inventory changes that we've seen out of crude oil numbers are certainly larger than was thought. And so what we end up with is this move. Of course, the markets had been concerned about oversupply for a while now, and perhaps now we have this confirmation. The numbers that we got today showed us an inventory jump, and we continue to look for more of that, apparently, if those expectations that have been coming out of private consultancies and NGOs are to hold up. So ugly day for crude oil as that settles in. Another rise for gold, 2% rise. Certainly nothing to sneeze at, and a relatively steady view for the dollar. Really no change against the euro, but as we get this pullback in yields, we nevertheless get weakness in the yen, which is an interesting dynamic. That's not typically the way that this works, but all the same, the yen is a little bit weaker. Bitcoin down again, this time off almost 0.9%. Perhaps the most interesting bit here is how different the week after Monday has shaped up versus Monday's price action and what looked like was the stage-setting move. So here's Monday. This is where we get that news that maybe the end of the U.S. government shutdown is nigh. And what do we see? Stocks are surging. Yields are firmly higher. Gold is up almost 3% in yet another piece of evidence that maybe gold is not what it's traditionally been, a creature of earnings and the dollar, because clearly here yields are up, but the dollar is steady and gold rallies all the same. So certainly no negative catalysts from the usual suspects, but there it goes. Bitcoin doing its risk sentiment on steroids thing where it goes up with stocks, but only a tad stronger than the NASDAQ, which is a bit weak in Bitcoin terms. One might have expected it to go up something like 4%, double the NASDAQ, let's say, give or take. But that's not what we see. And so what's interesting is how this contrasts with what we've seen since. Here are the past 2 days. And what we find here is the S&P and the NASDAQ are kind of idling. The S&P is a little bit higher. NASDAQ's a little bit lower, but nothing is really going very far. The situation in yields is a bit mixed. We're a touch higher on the front end. No real big changes there. We're a touch softer, that is, bonds are a touch higher at the long end. Maybe there's an element of risk aversion there. Gold is up almost 2% on the week. The dollar is a hodgepodge, a little bit lower against the euro, higher against the yen. And here now, Bitcoin looks a bit more like its usual self. It's down 4% over the past 2 days, with obviously most of that weakness recorded yesterday. So as we look at what this now suggests, we come back to this idea that the government shutdown deal was, as many of the recent headlines, really a reflection of a boost to sentiment in an episodic way. So a piece of potential event risk washed over the markets, whereby the baseline for the markets included the ongoing shutdown. There were signs that the shutdown may be ending. We got the positivity around that, and that's all she wrote. 1 day's positive reaction. Meanwhile, the underlying story is what we saw all of last week. Sharp decline in stocks, not much happening in bonds, steadying in gold, steadying in the dollar, sharp decline in Bitcoin. That is to say, risk off as the primary impetus for what we saw. Now, if we look today at what the price action wrought, the news flow is relatively straightforward. There's not really anything that's immediately shocking. We can look here at Fed policy expectations and see they're relatively little changed versus yesterday or versus a week ago. So since we made this correction from where we were with Fed policy expectations for December ahead of that fateful October 29th meeting, where the expectation was that the December cut was a near certainty with probability well over 90%. Now we're a hair over 60, and that's sort of where we've been since the 29th. So that much is stable, and we're not really seeing much of a difference there, certainly not today. A bit of Fed speak, that's something we talked about yesterday as maybe inspiring some kind of a response. And as we find out, there isn't much here either. We get comments from Atlanta Fed President Raphael Bostic. His big headline is that actually he's retiring when his 5-year term runs out. He is not coming back. And there's going to have to be a search for the new Atlanta Fed leader. the comments he gives are hawkish flavored, basically worried about inflation more so than what's happening in the labor market, saying that he's not detecting unambiguous signals of a serious cyclical labor market downturn. Meanwhile, clearly we have concerns here that inflation is stickier than perhaps is being appreciated. And the market ultimately doesn't do anything with this. And perhaps that's not terribly surprising. Bostic is not a voter this year. So he is not going to be someone that meaningfully alters the course of policy. And of course, as we just learned, he is retiring. So his level of influence here is somewhat diminished. With that in mind, we get comments from the resident dove, Governor Stephen Miron, who again was inserted most recently onto the Fed Governor's Board while on leave from his role as the chair of the Council of Economic Advisors at the White House. So this is the administration's man, ostensibly, on the Fed board. And this is familiarly dovish, no real major bombshells here. The labor market is softening and the unemployment rate is drifting higher. A 50 basis point cut would be appropriate, but at least 25 is what Miron would settle for. Policy should be forward-looking rather than reactive. That is to say, Governor Miron sees the economy as deteriorating and wants the Fed to help, which is an interesting sort of perspective for an administration that, at least from the White House's side, and we don't know if Stephen Miron shares these views specifically, of course, but he certainly seems to be arguing for a whole lot of easing, and he certainly seems to be saying that the labor market is coming unglued. The administration, on the other hand, is, of course, singing the economy's praises. And so, interesting disconnect there. They, of course, also want lower rates, but they're not letting the disconnect between a wonderful economy and lower rates bother them, whereas Governor Miron here is at least attempting to twist himself into this pretzel. When we look at then what the performance is for the S&P as a kind of stand-in for risk sentiment, we find nothing. We're idling. It is telling, perhaps, that we're idling at the same spot where we did after the initial sell-off post-Fed. Here was that Fed meeting. This was the day after, as the markets kind of decided what they thought of it. We then digested for a day or two, and then we got the meat of what the markets really thought, even as we got positive earnings announcements. This was, of course, the meat of the tech earnings reporting season, and clearly, despite the fact that tech earnings appear to be growing at a blistering 27% year on year in the third quarter, whereas overall S&P earnings are still very strong, growing at 13% year on year. Markets didn't seem to care. And that's the sort of thing that we've been looking at here most closely, this idea that perhaps the markets were priced for perfection already as of here, where you get this gap around the news flow that the Trump-Xi meeting was going to be relatively friendly. Treasury Secretary Scott Bessent was in Malaysia that weekend, basically ironing out all of the particulars so that the two leaders could essentially rubber stamp a cool down in hostilities. Those hostilities blowing up was, of course, this sell-off here. So as we come back here and reset around the idea that maybe this thing is going to get walked back, this is the gap where it ultimately does. This is tech earnings. As we can see, they're not bad, and the market sells off anyway. And this is the Fed. So if we had a three-legged stool here, whereby the trade situation with the U.S. and China was not going to be awful, the Fed was going to rubber stamp 2 rate cuts in October and December, and the earnings side was going to work out. We got 2 out of 3, and the one we didn't get was the Fed, which was right here. And since then, the market is down, tech earnings notwithstanding. What have we done here with the news of this government shutdown ending? Well, that was something that didn't bother the markets as it was kicked off. After all, here is the beginning of the shutdown right here. Markets weren't bothered by it. They were bothered by the trade war stuff here. And obviously, once the trade war stuff was resolved, the markets were still not bothered by the shutdown. So, goody, it's ending, but it wasn't anything that the markets were terribly worried about. And so, not surprisingly, we don't go very far. We get 1 day's rally. We reset to where this digestion point after the Fed occurred. And since then, where have we gone? So we're back at this inflection point. We seem to have taken yet another piece that was already baked into the market off the board as event risk and made it reality. And perhaps we're back to where we started, which is to say the one piece of this equation that wasn't lining up was the Fed. Now, maybe that's why we get the kind of standstill here in markets. But the real question, as we were saying at the beginning of the show, is gold, which continues to surge relentlessly. Again, up another 2% today. And we can see over the past 3 days, really since the beginning of this week, after a pullback here in the wake of this topping around 4,400, incidentally, this is ahead of the Fed that this topping occurs, we end up getting this violent rally. And not surprisingly, the question is, well, what gives? What's going on here? And as we go down the list, I mean, obviously, extremes in sentiment are not that, because while it was tempting to say so, and I did at the beginning of the week, as you get the end of the shutdown, stocks surge, gold surges, and you get the sense of, okay, well, maybe gold's becoming an overtly sentiment-linked asset in the sense that once you take away enough headwinds, the kind of speculative narrative that has been powering it all year comes back into the forefront. And the markets, with the removal of yet another headwind, get permission to re-engage. But stocks are stalling today, and gold is still going. So perhaps it isn't sentiment. It's certainly not the traditional catalysts for gold. Here we are looking at the bonds. Typically, gold and the bonds have a positive relationship because gold doesn't like higher yields. That's not surprising. It doesn't yield anything. And so if yields go up, then obviously there are assets who pay to hold and gold that doesn't. So when yields go up, gold understandably loses some of its luster. This is not what we're seeing here because we don't really get a big move from the bonds this week. They're still stuck in this range, and yet gold is rallying. It's not the dollar. So you can forget that debasement narrative nonsense because that's obviously not what's going on either. This is the euro as a kind of stand-in for what's going on with the dollar generally. And this looks identical almost to the dollar index upside down because most of that average is made up of the euro. It was an average created before there was a euro, filled with legacy currencies that have since become the euro. So this is the best kind of market-based liquid way of looking at the dollar's overall direction. And it's had some mixed moves. We saw that it was up against the yen. It's down a little bit against the Aussie. But this is the overall sort of average trajectory here. And we can see that the dollar is really trending higher since the Fed started rate cuts in mid-September. And we've only seen a little bit of a pullback over the past several days, but certainly nothing like what's going on in gold. Here are the past 3 days. We've barely gone anywhere. And the trend is still very much to the top side for the dollar, lower for the euro in the parlance of this chart. But certainly, whatever's going on with gold, it isn't a collapsing dollar. It's been going up and it's not collapsing bonds or some such thing. It's certainly not anything to do with rates. Rates don't seem to be going anywhere over the near term since we got this rise in rates, of course, after that Fed meeting. And we certainly don't have a sell-off here that might suggest, again, some sort of a sovereign risk or debasement risk. That's just not what's going on. So what is happening here with gold is profoundly interesting. And by the way, silver looks very similar, which seems to again lend this idea to the fact that gold has become not so much a haven of a sort of anti-fiat haven or a foil for interest rates, and is instead a kind of speculative asset onto itself, and perhaps reflects the idea that over the longer haul, we are going to have a bunch of economic uncertainty. We're going to have a Fed that's struggling to find what to do amid a dearth of data. We just heard today from a White House press secretary Carolyn Leavitt that maybe October's CPI number may never come out. Maybe the jobs report for that month may never come out. How the Fed is supposed to steer and issue rate cuts, of course, in that environment is an open question. So maybe what gold is doing here is reflecting a kind of general economic policy confusion, and likewise a ongoing sort of simmering cold economic war between the U.S. and China, where you might at any given moment see some kind of a deployment of economic weaponry on either side, and a kerfuffle for a period of weeks before everybody gets back into their corner. And so perhaps what we've seen is a sort of re-engagement of that here, and an idea that's really been with us since the beginning of the year. Pointedly, Bitcoin, for all the talk of digital gold, is not benefiting as gold is. In fact, it's actually falling. So, so much for it being digital gold. If anything, it looks more like gold is physical Bitcoin, because it seems to be actually serving all those functions, all those separated from government shenanigans functions that the initial believers in Bitcoin wanted it to serve. As far as policy expectations go, no big changes there. The markets still are priced for way more easing next year than the Fed has owned up to. That's perhaps still a source of reckoning for markets, because if the Fed isn't going to have data, if the fog is going to continue, and if the markets are that freaked out about the probability of a December rate cut going from 90 to 60%, well, then we're setting up for quite the rude awakening for next year. The market has 65 basis points on the board. That's at least 2 cuts and better than 50% odds, so better than even odds of a third cut. Meanwhile, the Fed only has 25 basis points on the board, and we've seen what this has looked like. So here's that second cut where Powell goes and tells the markets not to expect one necessarily in December, and stocks stop rising. So we're setting up here. I mean, we only have one meeting left for this year, so really 2026 is the operative story. And if the market is this disappointed in the absence of easing here, well, then it's got a lot more disappointment in front of it if the Fed is going to be relatively more staid. Meanwhile, the situation in stocks is dependent on them not being so. And so there seems to be a lot to reprice here. Dollar against that backdrop seems to have more room to go higher. It's been rising even as the cuts have come, and that's ostensibly around this idea that they were already baked in, and in any case, the markets are overpriced for cuts relative to the Fed, and if the markets have to readjust to the Fed's view of things, well, then there's more dollar gaining to be done here. Looking at the way that I'm managing my exposure around all of this, long gold flipping long gold at the start of this week. That's worked. This is continuing to work. Getting long silver around that same idea. That's worked. Being short Bitcoin still doing its thing. I'm long a put vertical there. I've added one long-term exposure here. You can see 429 days in this call. Not dissimilar from these calls I own in INWZ, Brazilian stocks. They're rising and working. They expire at the end of the year and in January. This MSOS is a cannabis ETF. It expires in January 2027. And the longer term flyer of an idea here is that it's going to come up in the midterms, and so I want to be there when it does. Still short risk via these put verticals in SPY, and still long the long end of the bonds in TLT, and short oil, which is working today. And that is macro money for this Wednesday edition. We'll be back tomorrow, as ever. We're here Monday through Thursday after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.